the way we try to invest is we try to invest where we see a lot of upside, limited downside, and have optionality in all of these things. Instead of just waiting to have the perfect plan to just get it right, I want to try, do, and constantly innovate and improve and lean into what we're doing really well. And the things that don't have a big impact, we stop or can pivot or change direction or change. And what I've seen is, and I've seen this in my life a lot, is like if you just try things, you figure out what works and what doesn't. But if you just sit there and just wait, then time just passes and you never get anything done.
Jonathan, I thought it'd be really cool to start with how you think about hospitality investing in the context of real estate cycles, because we're in this crazy cycle now. Maybe it's the start of a new real estate cycle, but I thought that would be a really interesting place to start.
Yeah, no, it's an interesting question. And Jake, thanks for having me on. I'm excited to have this, conversation and it was great that we got to actually spend some time in person this week as well. So, I think it's interesting when I first started to have to focus my career a little bit in hospitality, in sort of 2007, 8, 9, in that time frame. One of the reasons why I did was, unlike other forms of real estate, because it's so operationally intensive and capital intensive, I thought that there was more opportunity to invest throughout any point in the cycle. At some points there'd be more things to do. Sometimes there'd be less things to do, but that there were always people getting in trouble in, ways that were not just related to cycles. And so, I think that's actually been true over the course of my career. But it's interesting. You never know exactly when you're going to find opportunity. So I tell people, I started EOS in 2017, and I always tell people that, from my perspective, the stars aligned. Everything at the firm I was leaving was sort of put to bed. We had sold a bunch of our assets. We had refinanced the rest of our assets, and it was sort of a clean time to leave. And I had investors that wanted to back me in doing that. And then when I went out to talk to the broader industry about starting EOS, people couldn't believe that I was starting it when we were, 8 or 9 years into an upcycle for a highly cyclical business. And so, to me, you can never exactly figure out when cycles are going to start, when they're going to end. You can look at, data for historical cycles, and try to, think about where you are in the cycle. But generally cycles, end with events that are completely unpredictable, or predicted. And so, we are always trying to invest for sort of like the long-term trends and making sure that we're capitalized in such a way that we can deal with shorter-term volatility. And so, I think the way that plays out in practice is, there are times that we are incredibly aggressive and think, and I'd say, we're more aggressive than the market, or we think that there's more upside than the market thinks. And that's when we're highly acquisitive. And then there's times that we are less aggressive than the market. And that's when we're actually, generally sellers of assets. And, it comes in waves. And so when I look back, and this is not by design, but over my career, we usually are big buyers in chunks and then, go fairly long periods without buying assets. And I think, we've obviously been in in EOS's history, which is 7 years now, we were sort of like we viewed it as very late cycle at its onset. We viewed, then COVID obviously hit. Then we were in this sort of very short post-COVID ramp up, and then this, huge interest rate growth period that has, obviously had, a lot of stress in the industry. I think in our 7 years in existence, we've actually gone 3 of those 7 years without investing any capital. And then 4 of those years, we've been highly acquisitive.
How does your approach change based on your perception and what's happening in the real estate cycle? It's you said it's hard to identify, but are you changing your approach? Not maybe your investment strategy, but like how you approach finding deals, structuring your deals, that sort of thing.
Yeah. Well, I always tell our team that, well, we can't predict, right? Um, we are, supposed to anticipate. And so, in 2017, when EOS first started, we actually fundamentally changed the way we were underwriting, our base case assumptions. And the main thing that we did was that we took sort of our traditional or standard 5-year base case model and we extended it to a 7-year model. And we took every single market that we were investing in and we took it through the worst downturn that every single market had happened to those markets in years 1 and 2, and then took them through a recovery. And the reason why we were not very acquisitive in that period of time is not because we weren't trying really hard to find things to buy, but when you did that and you were competing against people that I assume were not doing that and keeping to shorter hold periods without holding through, an economic downturn, we were ultimately getting to prices that were not the market clearing prices for assets or prices at which owners were willing to sell, right? And so, that's basically what we've seen over the course of my career is that, you're always trying to figure out, okay, because once you own something, you, for better or worse, it's yours, right? And so, you're not trying to get to the highest price. You're not trying to buy you're trying to do a lot of what you really believe in. But when you make a bad investment, it's tough. And if you have 10 investments and one's not going well, you spend a disproportionate amount of your time on that one investment. So, I've always felt like, it's important to be cautious and have a lot of conviction, but the bar is very high for us to invest. And so, even though we obviously didn't know when there was going to be a downturn, when you looked in 2017 at historical cycles, in the 90s and the early 2000s at the GFC, cycles had sort of been, 7 to 9 years in length, and we were getting deep into it. And so, while we didn't know what was going to cause it, and obviously, no one foresaw COVID coming, we thought that there would be something. And there ultimately was something that caused a big dislocation. And as a result of that, what we were buying before the cycle turned, or before COVID, we ultimately had relative to the industry much lower leverage, much higher cash flows. We were in markets that had no supply growth and growing demand. And so once we were able to sort of get through that period of dislocation in early 2020, our capital structures are all in good shape. Our assets are, back to, generating positive cash flow. And so, we've sort of gotten through it. And so, I guess what I'd say, what is interesting is, having started my career in the early 2000s, I guess what we're in right now has sort of been the second downturn that I've been through. The GFC was the worst. And you talk to industry veterans, and then, COVID, and now this seems, potentially even more severe, especially in hospitality. And so, even as cautious as you try to be, things can be worse than the worst downturn previously. And so I think it's more important than ever not to sort of wink at risks and to really try to understand what's out there and what you're protecting against ultimately, for your investors and for yourself and for your company and everything.
And over your career, how have you figured out to not run away from the risks and maybe look at the base case potential as the worst case scenario, but not the metrics that you're actually going to buy the asset on or think about making the investment? Because I would think if you're looking at every deal on a worst case scenario, you'd probably buy no deals. So how do you strike that balance?
It's a funny question, and I've I've thought about it over. I've thought about it especially over the last couple of years, um, and it's interesting. Now doing this for a long time, I have so many friends in the industry. Um, but if I'm being actually honest about like how I see myself in the industry, is I've always seen myself as a little bit of an outsider. Um, and I don't know if that's because so much of the industry went to Cornell, or or what the inner circle, or the old guard, where it came from, or what it did. But I've always sort of like felt like we've been very active and big and active participants in the industry and friendly with everybody, but really trying to create our own views. And I guess the reason why I've thought about that is, there's been a number of times in my career where we've invested where other people haven't been. And our biggest question that we've asked ourselves when we see this and we see huge opportunity that no one else is in a pretty efficient world is why no one else is there. And we rack our brains and we try to figure out what are we missing because we're new and we're young, and are we thinking about things right? And but we generally have a very simple investment framework. It's very data oriented. One of the great things about the industry is it's got fabulous data back to 1987. So you at least have good data through 3 full cycles, supply, demand. There's actually really good supply data going forward. And, ultimately our investment thesis is incredibly simple, is to try to buy, non-commoditized real estate, which means that, assets that people will pay more to stay at. So they won't just shop for the lowest price, in markets that have attractive supply demand dynamics. So ultimately where demand's outpacing supply, occupancies get above thresholds where you have pricing power and you can use operational leverage to your benefit. And there's large periods of time where the market or the industry at whole is sort of focused in the right places or in the same places, or that's where there is growth. And then we've found at points in time there's been huge pockets of opportunity, and we're trying to sort of get into those pockets of opportunity before others, and then trying to make sure that we are actually seeing something correctly and not doing something that everyone else isn't seeing things right, and that we're actually onto something that could have a lot of legs.
I want to hang on the outsiders comment for a little bit because I think it's very insightful, but also very true. And it's weird because hospitality is a very small industry. But I do think that particularly with the introduction of all of the private equity funds and big institutional capital providers, that there sometimes does feel like a very big herd mentality. And when you go to conferences or when you talk to people, a lot of people tend to say the same thing. And a lot of the times I feel differently. And I found in my experience, when we are getting off-market deals and we have the most conviction around something, that is when some private equity firms tend to have the least conviction, or just generally pencils down for macro reasons that have nothing to do with the deal. With your background coming from that world, was being an outsider kind of your attempt to basically carve your own path and break out from that, as opposed to just becoming a CEO of one of the firms that you started at?
So my path. So I started my career off at Goldman Sachs, and in the early 2000s, I started out in investment banking, which was an amazing training ground to try to sort of understand like the framework of all of the public real estate world. Then I switched into their private investment area, where the funds were mainly allocators, and so partnered with local operators. And by the time I was already there, it was an incredibly big organization. I mean, I think at that time they were one of the largest owners of real estate across the globe. And what I felt there, and I was there for about 2.5 years, was ultimately I felt very removed. And I was young, but very removed from actually what was driving performance. So, I was working across all property types. Our local partners were incredibly savvy and talented. They would send us pro formas. My bosses would cut things back or figure things out. I was processing it. And I looked around and, I was sort of like a big coordinator of everything, right? The diligence, and you would call these people. And ultimately, I had unease about that because, being at that time, I guess like 25, 26, my whole career was ultimately really dependent on this big machine and what skills would I actually be able to do on my own. And so I've always been entrepreneurial. So in 2007, I went and was the third employee at this firm called Northwood Investors, which was started by John Kukrow, one of the founders of Blackstone's real estate group. And, when I was there, and early on, and there was no infrastructure and you had to figure out how to buy things. It was a super efficient time. It was before the GFC. It was in early 2007. And, what became clear was that you had all these local operators that were finding all these deals. You had all these big private equity firms. You had the public REITs. You had this super efficient market. And if you wanted to make any investments, you had to try to not only find that investment, but you had to find the right partner, and then you had to give up the biggest promote. And it seemed like this adverse selection mixed with ultimately really bad economics to your end investors. And so it seemed like a really bad setup. And so it was sometime, in the, I'd say early to mid of 2007 that we made the decision to say, okay, we need to take a more proactive approach. And so the way we're going to do that is we're actually going to source everything. And if we sourced everything, we had to underwrite everything. So we weren't relying on anyone. And then we had to then figure out how to run it. And those were all different decisions. And so, then the GFC started sort of middle of 2007. I think that's when you had Bear Stearns go under. Then you had middle of 2008. I think that's when Lehman ultimately went under. And then, we didn't buy our first hotel until the beginning of 2010. We bought a $5.5 million hotel in Houston, Texas, right? So in some ways this was a huge blessing because I had this huge amount of time to actually figure out how to do this. Because even though I had training in real estate a bit, it actually wasn't really that transferable to what we were trying to do, which was really a true ground up approach to underwriting real estate, operating real estate, building relationships, and all of that. And so, in that time frame, that's where this framework came from to say okay, I don't know, there's not long-term leases to go back on to model. So how do you know what revenues are going to be like next year? Or how do you know what expenses are going to be? And I still remember, the first hotel that I tried to underwrite for myself. And the office I was sitting in, and I was like, okay, so let's just assume that revenues grow at 3% and expenses grow at 3%. What happens, right? And then, well, what happens if revenues are higher? And then how could I get comfortable if that would ever happen? And what expenses go up more? And so, figuring out all of that, right? That was a very, isolating process, because some of the people that were probably the most savvy to do it in the industry were people that we were not going to be working with. And so you couldn't have them sort of teach you. And, you had to figure out your own foundation. Right. And that foundation from what we did, at that point in time, I underwrote every single investment opportunity that was in the market, every single one. I'd fly to every market, see every hotel, try to figure it out, talk to them, see what GMs were saying. And so it was this very ground up approach to trying to build conviction. And it was a very sort of insular approach that was first me and then our team. And, ultimately it grew. And as we bought assets and we had real life examples to see, what was working and what wasn't and how it all played out. And so, all of that was sort of done pretty, in a pretty, isolated way. And so, um, now through all of that, I've made unbelievable relationships, great mentors, unbelievable partners, great counterparties, and terrific friends. And so, it's not, now I don't feel like an outsider in the sense of like not being welcome in a community. But I still feel like the way we look at the world, at points in time is different than, the herd like mentality, the group think that can sort of creep into the industry.
I want to go back to the debt piece because across real estate cycles, you'll find the wealthiest people are the people that have owned real estate the longest. And debt is typically responsible for the majority of blowups. Like maybe there's some scenarios where markets turn and they never recover. What does this strategy around debt look like at EOS?
I think debt is, to me, I always like to keep our financing assumptions very simple. And so I always say we like to use, and this is a vague answer, and then I'll get into it a little bit, but we like to use the appropriate level of debt to maximize returns without putting financial risk into the investment. Because what I have seen in my career is even if something doesn't blow up, if it is financially tenuous, you will make the wrong decisions. You will not invest where you have to. You will not, you will cut expenses when you should be reinvesting, and you will be doing all of that. And so ultimately, to create the best outcome for our investments, we need to not have financial stress in the system. I think across all of our investments, what that's ultimately led to, and so I guess typically what I'd say is on a financing basis, historically we've said we're usually sort of max bank lending borrowers. And so we would go out, we had great relationships with a number of the large banks, Wells Fargo, RBC, Citibank, and many others. But we would generally figure out what they felt comfortable lending. It was sort of a low cost of capital. We would take those proceeds levels. We generally didn't borrow with a lot of mezz, in small instances here and there, but generally we had, sort of max bank financing. What that, historically meant was usually like 65% of purchase price was sort of where you could get to in the bank market. And then there were a number of assets where we were lower levered because they were more transitional. We actually own a couple of investments completely unlevered, because we, have said, look, there's risk to this certain period of time. Let's own it unlevered. Once we stabilize cash flows, then let's put on the debt. And there's a couple of investments that we bought that had a lot of cash flow and going in yield where we were a little bit more levered than 65% going in. So I think on a blended basis, we're about 50% levered on the portfolio, with a number of assets at 65, some unlevered assets, and very few that are more levered. And then, every time we sort of get big cash flow growth, or there'd be a situation where we could either look to monetize, either sell or refinance, we go through a process of saying, okay, what do we think the next couple of years look like? Is this something that we should do? And so we are actively refinancing our assets, when we own them, to make sure that the financing is always optimizing our returns without putting risk in. And then, one of the things that I'm incredibly, fortunate that we did is that we're very conscious. One of my good friends is the one who I would give credit to for telling me this. And this is, back in, he's been talking about this since the, 2017, 2018, before we even had debt. He said, you should always be focused on the length of your untested term. And so, even though we might have maturity dates that are 3, 4, 5 years out in the future, we're always focused on how much term we have before we start to hit any financial tests. And so, as we owned a lot of resorts and they did incredibly well, we refinanced our entire portfolio at the end of 2021, early 2022. And so, one of the reasons why we're, sitting here without, you know, real debt issues is because we, have basically pushed out the terms of our debts, far. And so I think, people usually like to talk about financing just in terms of like attachment points. Um, but to me, it's not just attachment points. It's also making sure you're very actively monitoring that over the life of the investment to optimize your returns, but also make sure that you don't get caught, with any type of issues, because the world's just getting more and more volatile.
Do you have a position on fixed versus floating rate debt, regardless of where we are in the cycle? Is there a philosophy that you live by at EOS?
We've generally been almost exclusively floating rate borrowers with hedges and try to buy long-term caps. And generally, and this is, I guess, over the course of the last 20 years, what we've seen is cash flows in hospitality are usually pretty correlated to the economy, which are usually pretty correlated to interest rates. And so, outside of this time period where there's just a ton of noise happening, we've valued sort of the flexibility of floating rate debt to sell or refinance, earlier in hold periods, as opposed to fixing it. We fixed a few things over time, but for the most part, we're floating rate borrowers with long-term caps in place.
If your focus area is primarily non-commoditized hotels, what does that do to your evaluation on supply in markets? Is that something that you're very concerned with, or are you making an assumption that in a lot of the markets you're investing in, it's very difficult to replicate the potential investment that you're making or the asset that you already own because it's so differentiated?
We are maniacally focused on supply. So, even though non-commoditized hotels can, outperform or might not be quite as sensitive to supply, I'm a huge believer that every ounce of new supply is competition. And it sort of trickles down. I think, in certain things that we look at buying, you actually realize that supply might not even competitive supply might be broader than just your geographic market. And, it might be dependent on what's happening in neighboring markets, or, if you're buying a ski resort, like it's actually how much new supply is happening at any other ski resort in the country. And so we are always trying to figure out like what supply is competitive, but for sure, anything at any level is really competitive, in a given market. And then, I do think luxury is a bit immune from, more commoditized supply, but, as you go up, even, I think it's becoming harder and harder to differentiate. And I think you see it in the rates that different properties are getting, between, 3-star, 3.5-star, 4-star, even 4.5-star. Where is really the cutoff point and where people won't stay or will stay, I think is, becoming much more fluid, especially over the last decade with, I'd say, really like the proliferation of select service hotels and how nice they've become and how new they are and the amenity and what people want. And so I think supply is ultimately the kryptonite to revenue growth. And, you have to be focused on it, and, all of it's competitive.
Do you think about rate ceilings in these regional resorts or non-commoditized hotels? It seems to me like whether it's a 3-star hotel or a 4-star hotel, people aren't associating price with the services or the star rating. They're associating price with the experience that they get and the value that they get. So have you found like this sweet spot anywhere on that range where you feel like you can maximize price relative to the luxury value of it?
In those markets, in the resort market specifically, it's, I'd say that the opportunity exists all the way up and down. From 3-star to 5-star, there's it's really about the right assets in the right markets, and the right tiering and the experience that you deliver. And so we've seen great growth sort of in that entire subsegment of the industry. And we saw it for, a decade before COVID, actually. Saw it, and if you look at the data, it really goes back to the 90s. It's basically been outpacing almost everything else in the country for 30 years. And I think that the trends towards drive-to leisure are going to continue to be incredibly strong, and there's no supply. But I think there's points in the cycle where the higher end assets grow faster. There's points in the cycle where the lower end assets might grow a little bit faster. But wholly speaking, anything in that range has performed incredibly well. And I think as airfare continues to get more expensive, international travel continues to be harder. People have discovered these destinations. People have more flexible work so they can take more long weekends. I think all of the tailwinds towards that subsector, are continuing to be incredibly bright. And one of the things that's not intuitive, but this goes back all the way to the downturn in '01. You saw it in the GFC. You saw it, in a unbelievably pronounced way during COVID, is that people's vacations, while they seem like discretionary spends, they're not. And so they might be discretionary in the magnitude of their spend, but they are not really discretionary in whether or not people will take them or take that time with their family. And so ultimately what we've seen and why we love that space so much is if you do hit tough economic times broadly and people still want a vacation, they can take a much less expensive vacation by just cutting out airfare. And so they can drive to their beach or their, wherever is sort of within a couple hour driving distance, and they can save a ton of money or reallocate that spend in other ways. When times are good, markets that also have, desirable amenities, but also have no supply, have great pricing power. And so generally speaking, we love sort of like the leisure play where, there's no supply almost at any point in the cycle. You just have to underwrite it correctly, because over long periods of time, demand for leisure spend is far outpacing, the flat or in many cases negative supply that's happened over the last couple decades.
What drew you into hospitality and made you want to build a business all around hotel investing?
So I realized probably about 15 years ago that, I was curious, and actually the pillars of EOS are that we want to be a kind and a curious company. And I think that when you take those two words and you sort of think about what they all encompass, they encompass so much more. But I've always been a curious person, and that started from, wanting to start my own company, going to smaller companies and whatnot. But when I would go, and this was even before I was focused just on hospitality, when I would go and I would stay at hotels, every time I'd go to a city, I'd go and I'd stay at a different hotel. And, I did that because I was just curious about like how people were staying, how people were using spaces, what they were doing. And as I started investing in hospitality, what I loved about it was that it touched everything. And it was really like this window into the world. And so I could actually talk about everything, right? So exchange rates mattered, what demographic trends were mattered, how cities were moving mattered, what events were happening in different cities mattered, everything. And so it allowed me to sort of, not just be curious and care about the world and being an active participant in the world, but actually to use all of that to hopefully, make me better at what I was doing in my day job. And hopefully be a better husband and be an interesting husband and, interesting to the people around me and not just be so, closed in terms of like what I was thinking about at work and how I was segmenting. And I sort of like to have the overflow of, my personal life into my work and vice versa. And, really sort of a big believer in like living one life, right?
What are some of the insights that you picked up on, whether it was early on in your career or now, just by being immersed in hotels, whether it was on business or on personal vacations, that you've made a point to integrate into the investment philosophy that you have today?
You know, ultimately, I think it's a balance between trying to say, what do I like that I think the rest of the population will like, and that matters, and what do I like that just doesn't matter for an investment. And that's the tough thing to sort of separate, right? Is personal preference versus overall big trends. And so I try to always have a lens of, why are things happening? Why might I be interested in them? Do I think that that is happening more broadly, or is that a unique, specific thing that might be happening to me because I'm growing up or getting older or having a family, or is that something that fundamentally is changing in society? And so, I think that again, what's important is to try to block out all the noise that comes at us every day. More than ever, there's more data. Sometimes that data is right, sometimes that data is wrong. But really trying to decipher what's happening, why it's happening. Most things don't fundamentally change quickly, but in the last couple of years, some things fundamentally have changed very quickly, and some things. And so it's really being curious about what's happening more broadly speaking in the world, what's happening, to me that I might be seeing, how does that dovetail? And then are there underlying causes for how that's happening? And then really sort of always going back to data to say, ultimately, does the data prove out what we're thinking or not? And actually, realizing that it doesn't matter what our initial thesis was. If our initial thesis made us run down a path, and then we realized that we were either right or wrong on that, then being actionable against it. And so, I think fundamentally, in the last couple of years, and I think some of this is, true for me, but, I think, the data starting to prove it out is, there's all this noise in sort of the shutdown and then the reopening, and then, how people were traveling, and now this reversion to norm a little bit more, but where do we ultimately settle the real thing? But fundamentally, I think two things have happened in the last few years. I think one, remote work is more prevalent. So it's not going to be fully remote. It's not going to be fully in the office, but I think, what it looks like is sort of stabilizing is that while people used to be in the office on average close to 5 days a week, that's stabilizing now on, around 3.5 days a week across the country, right? And so how does that impact how we're going to invest and where we think everything settles? And then two, I think there's a lot of sub reasons for why that can happen. Two, I think the other thing that's happened is because, COVID was such a long duration, people value time together, especially, personal time with their family more than ever before. And so I think that those two fundamental things will likely alter the trajectories of where stabilization occurs as we go out. And then, like everything, off of those two effects, there'll be derivative effects and things that you have to be cognizant of. But that's sort of, how we see what's happening right now in the world, and you're trying to apply that to how we're investing.
In your own portfolio, how do you rationalize having resort hotels and then maybe more urban hotels that might not even be resort urban? They're more like corporate urban, because everyone likes to kind of put you in a box. Like, you're the boutique hotel guy, you're the resort guy, you're the limited service guy. How have you figured out to have a portfolio with both types of assets?
So it's a great question, and I actually can answer it pretty directly now, as opposed to a couple months ago where I probably would have fumbled a little bit more. So going back to creating this framework of how we invest, historically, what I've said our main focus was wanting to know everything that's going on in the top 7 urban markets in the United States, and then in resort markets, which had generally meant top 7 urban markets, Florida, California, and Hawaii. And then our definition of resorts continued to expand, as we went sort of all up and down the East and West Coast, and saw similar dynamics in less known markets that were drive to from incredibly fast growing and large cities. And so we continue to think about it, but at our core, that's really like where we've seen markets have pricing power over the last 30 years is in those places. I always pushed back when people would say, well, how do you focus? Are you resort or are you urban? Because I said, look, I think hospitality is narrow enough. So we do everything in hospitality. But I think actually the next step of the evolution to that is, what don't we do? We have generally not been, and we don't have the experience in doing large scale select service commoditized product. There are a lot of groups that have done that for years. They're terrific at it. They've made a lot of money doing it. I've never fully understood the investment premise to where we allocate capital into it. They have. And so if we saw something in that space that was so interesting, I would have a very tough time understanding why this was coming to us or why we were doing this and whatnot. And not to say that we won't ever do it, but I think that we will highly likely not be doing it. We don't traffic in it. We're not the go-to person to call like we are for other things. And so, for me, while we do corporate and urban hotels, hopefully that do have a big leisure draw to them usually, and we do resorts, I think we understand those two segments incredibly well. We have a great framework that we feel very comfortable with that gives us conviction to be, very acquisitive at certain points. And so I think that we'll continue doing it. But, across the whole broad section of the industry, I think there's a lot of stuff that we just don't do a lot of. And I'm curious about it. Like, I actually hope that we will figure out ways to, participate in being successful investors in it. But at this point in time, I think there's been so many people have done so much more of it and do it really well that it's not a logical thing for us. And we still don't have like a real thesis on why we should, but why now is the time.
So I want to go back to something that you said at the beginning of your answer. And you said a couple months ago, you would have fumbled through it. Did something happen in your company from a strategy standpoint or an epiphany over the past couple of months that led you to frame the answer in that way?
Yes. I think one of the things that I love about my job is that I learn every day, and I learn in all different ways. And I want EOS to be a learning culture. And over the last couple of years, or I guess one of the parts of our business is that we are fundraising, and one of the things that I think we do well is I think we build a lot of trust and really good relationships with our investors and our prospective investors and our partners. And there's one group that we have a great relationship with, and we've talked to them for years, and but they haven't yet invested with us. And I said to them as part of the last, I said, hey, like, I know that this might not be the right time. They don't have an allocation right now. And I said, but we've had such a great relationship. I would love your advice, because you hear from people all the time. Like, how could we improve? Like what would make it whatever? And the question and the feedback that he said, what I think you would be great at telling is like, what won't your portfolio look like? And I said, that's really interesting, because in my mind, it's so clear, and I've been doing this for 15 years, that I have a very clear vision of what the portfolio will look like. And I actually, for some reason, try to push back against the constraint of being too constrained on what it's going to look like. But the reality is, no, like our portfolio is not going to look like so much over here. And so let's actually talk about what it is going to look like and why, and what it's not going to look like and what you can expect. And that was an incredibly clarifying moment for me because, I like to think that we're incredibly smart. We'll find where the opportunity is, opportunity moves, and it might, but now we've been doing this for 15 years and we have a lot of conviction in where we invest. And so I think that I've taken a lot of comfort from that and understanding look, you are like, if you have beliefs and you believe in them a lot and, they've done well and you sort of build on them and you lean into it, like it's totally good to say what what it is going to be and what it isn't going to be.
I love it. There's that old saying, it's like, go seeking advice and you'll get money. Go seeking money and you'll get advice.
I haven't heard that, but I like that. But it was really interesting. And one of the things I'm actually really focused on into the next stage of the company is continuing to really build our learning loops, and ask for feedback everywhere, right? How did this go for when we bought a hotel? How did it go when we sold the hotel? What was the learning lesson from this process that we ran or this? And, how could we be better or learn? And, it's interesting because people have all these, they're happy to share it, and there's perceptions in life, what's the meaning of life? There's a couple of them, but we just want to always get better and learn and be curious and hopefully leave the world around us in a better place. Be good to all the people we interact with, and just continue to improve as people.
What does your strategy sessions look like at EOS? How often do you review the strategy? How often do you revise the approach? And who's involved in that process?
The company's evolved and grown a lot over the last 7 years. So right now we've grown. So we're a hotel investment manager, and then we have a hotel property management company. Between those two divisions, we have about 60 corporate employees and probably about 5,000 employees that work at the hotels. And those two groups work incredibly closely together, but they also, have, their own focus to it. And so, as those areas have grown, the strategy of those areas, have differed a little bit, but the commonality is that, we all want to think like owners. And, and the one thing that is pervasive through our company and through our whole ecosystem, and I think it was Charlie Munger who said this, but, show me the incentive, I'll show you the result. Everybody, everybody sort of shares in positive outcomes, in a very similar way. And so, and that's not just corporately, we actually extend that all the way down through our, senior property level teams in many cases. And so, the strategy I would say, is to, on the investment side, is to continue to be cautious, to be cautious, but have conviction. And, I think that is sort of what we do on a daily basis. And then I think, on the management side is try to be, how can we continue to be innovative, and to manage, the portfolio that we manage, in the best possible way, given all the changes. So how do we use being smaller and nimble to our advantage, but how do we use the scale that we have now also to our advantage so that we're not too small or too big to sort of move. And so we're be right at the sweet spot of that. The strategy, I would say I would hope that we are continually evaluating it, at all times. So, every single day we see data, we see bookings, we see everything, what's changing, what's not, should we be changing how we're doing, and so, I'd say generally we meet at the beginning of the year, or around this time as we get ready for the end of the year into the beginning of the year, and try to create sort of an outlook for the next year. That's on our individual assets. That's broadly on how we're going to try to acquire, what we're going to sell. And, we try to set that strategy up at that time for the continuity, for the next year or so. That said, the strategy that we've had, I think, is like a winding road over the last 15 years. And so, what I take great comfort in and actually continues to build conviction is we were probably the largest buyer of drive-to leisure properties in the United States in 2019 and early 2020. COVID, which we didn't expect, happened. Every trend that we saw then still holds today. In fact, the line, got a little bit more favorable. We continue to be big buyers of that. We've waited to see some of the distress in the urban markets play out to hopefully create buying opportunities. We didn't see it for a long time. We're starting to feel that stress come. And so none of these things, I don't think it's a change of strategy. It's just sort of like an evolution of where we are in the time frame of where we're going to be focusing. And so, we have about 10 senior people at the company across the two divisions. And we get together, on a monthly basis to make sure that we're exchanging information sort of formally in a group, but the dialogue's happening amongst the 10 of us, and really the 60 of us and hopefully the 5,000 of us, on a daily basis. And I think the numbers have changed a little bit, but basically what I've always tried to figure out is it's if we can have the strongest connection from 10 to 60 to 5,000, right? Or 20 to 100 to 10,000, whatever the size is, if we can make sure that we're seeing it and getting information flow from the properties back up to ownership back, in a very fluid way, then we're doing it, then we will be at our best.
Where I feel like we've messed up has been sometimes as we've grown, getting the communication back from the operation side so that they feel like they're also in the owner's seat. Have you done anything unique or special, maybe special to you, insightful to you at your company to make that communication flow really seamless? And I do want to go into the incentive component, but outside of that, is there anything that you're doing to make sure that link doesn't break?
Yeah, I mean, we're doing a lot. I think that we are better than ever at it now. I don't think we've lost anything with size, in scale, and we're still not that big, obviously. But we really do view the general managers of our properties as the CEOs. And the job of our corporate team and ownership is actually to provide expertise and resources where needed. But when this is working really well, the general managers are really empowered to run that property. And a lot of the driving happens at that level and sort of our regional level, sort of that, sit really outside of the corporate entity. And we work very hard to try to make sure that the corporate team is not just, is creating any bureaucracy, right? And so bureaucracy is sort of like anything that, is sort of a time suck or, not allowing the properties to be as nimble as they can be, right? And highly incentivizing the property in many ways to raise their hand when there's issues that are 6 months out. Because what I learned early in my career is if you see an issue 6 months out, maybe you can not deal with it and hope it goes away, but it almost never does. If you have 6 months to plan against it, you can really mitigate it. If you don't plan against it, it could become an issue in 6 months. And so we need people to raise their hands early and often, and feel that there's a safe culture to do so. And if they do, that, we're going to sort of see that, hear that, and then, hopefully add value from ownership or from corporate operation levels. Um, you know, and then where it works really well is if we can create good ideas, we being the corporate team, not just me, where we are actually bringing ideas that they wouldn't actually hear from anybody else, that they say, wow, you're now making my life better, or wow, that would be amazing, or wow, I haven't thought about that. And we do have a number of examples of it. But a couple of things that I do want to highlight because they are unique and they are having huge impacts. And I'm excited about this hopefully becoming much more of a norm, is that we became one of the largest third-party management companies in the country about 2 years ago to offer paid parental leave to all of our hotel level employees. And so, that is not something that happens broadly. And actually, yes, on its face is, an incremental expense. But we believed, and when we did all the work and the data on the program that we wanted to roll out and offer, we actually believed that through retention, recruiting, a talent, attracting better people and everything, that it was an enormous benefit actually to the properties, to the teams, to morale, ultimately to the guests of doing it. And so we actually rolled that out. And, when you roll that out to, and that was a corporate initiative, right? And the general managers see that and the executive teams of the property see that, I think it actually starts to build a real camaraderie of culture and say, hey, like, we're working with great people. They're trying to be innovative. They care about us. And it's not just about, maximizing, the dollar on, for the next month, but thinking about long-term, our families and everything. The other thing that we've done, which has also had a tremendous impact, is we actually at many of our properties now charge a social impact. We've created a social impact fund that we have guests contribute to, and we plan, and actually the properties figure out where we invest that capital that's most impactful in the communities that we currently are located in. And so what's amazing about that is that we all of a sudden in those instances go from just being this like standalone entity to really being integrated into the community, what's important. And, as a very heavy people business, right, our employees and our team members live in the communities in which we're doing that. And so there's a real sense of pride. And we've seen some pretty wild feedback loops there that we didn't expect, which were, and we're trying to figure out how we get this even more out into like guest consciousness, because we've even seen some guests say, oh, wow, we saw that you do this. Like, would that be something that we could participate in? Not just monetarily, but actually like as an activity. And you're like, okay, so like this whole like being a part of a larger community, giving back, being together, has a lot to it. And so, I think that while we all have our own, lives that we're dealing with and our own problems and our own excitements and families and this and that, is that we do spend a lot of time working and, trying to create continuity and culture and ownership, at every level of the organization and every property is something that we're incredibly focused on. We're trying things, we're being innovative, and we do those things. I view that as actually an extension of investing. The way we try to invest is we try to invest where we see a lot of upside, limited downside, and have optionality in all of these things. Instead of just waiting to have the perfect plan to just get it right, I want to try, do, and constantly innovate and improve and lean into what we're doing really well. And the things that don't have a big impact, we stop or, can pivot or change direction or change. And what I've seen is, and I've seen this in my life a lot, is like, if you just try things, you figure out what works and what doesn't. And, but if you just sit there and just wait, then, time just passes and you never get anything done.
Absolutely. So you have a vertically integrated company, and the beauty of that is, as the owner and the operator, you can do whatever you want from an operations side. There's no one to answer to but yourself. as you've been growing the management platform and getting into third-party management, you now have a different person that you have to report to that may have different views of the world. And, one of the things that we've sometimes run into is like someone might say, hey, your cost structure is so much different from another person, another manager's cost structure. And it's like, yeah, that might be true, but we're also a very different company from that other company as well. What surprised you most about going and building the third-party management business?
So I have a 10-year-old daughter, and she what she's learning a lot about in school and has for the last couple of years, or I've learned from her, is this whole thing about having a growth mindset. And it's all about, okay, so you get something right, that's great, but if you get something wrong, like that's really great, because then you could really learn. And I love, I love the way that's termed. And I think it's an interesting thing, and I think something that I'm proud of how I hold is, while we have conviction and belief, we always want to figure out how we can be better. And I think that gets back to being curious. And so, one of the things that we're doing on the third party side, which, is incredibly important to me from a strategic standpoint, is we really only want to manage for a small number of owners who we are important to, and they are incredibly important to us. And we want them to view us as, their most trusted partner. And we want to view them as, an unbelievably important partner of ours, where we can have very open dialogue about how we can do things better, what we're doing well, what we're not doing well, and that we are focused on it as if we were the owner. So just like, on our owned assets. And I think what's important about that, and our third party, our managing hotels for third party as a couple is only a few years old now, is that the people that, like everything else, the people that you work with, and the people that you partner with are so important, because we spend so much time investing in the culture of this company. And by definition, like, that is an extension of our company and the culture that we want to have. And it is actually great, because the thing that's so good about having third party management is that when we have kind and curious people on the other side of that partnership, we are learning from them. Hopefully they're learning from us. We're putting it together, and then we're being much better and much more impactful. And there's things that the thing about the hotel business is that there's a flip side to everything, right? You spend more money, is there an ROI on it? You don't know, and so, having people that will try things with us, will be open-minded to trying things, us all recognizing, no matter whose idea it was, if it worked, let's do more of it. If it's not, let's scale it back, and dealing with, people in a very kind way, is something that I think is just so additive to the ecosystem. And so, it's really about making sure that we can continue. So my wife, who is, really the driving force behind everything I do, is, she was the inspiration behind the name of the company. She's an author. She's an amazing author. Anyone listening, I hope you buy her books.
Plug it.
All right. So her name's Christina Alger. She's a New York Times bestselling author. She's written 4 books. Her most recent is a book called Girls Like Us. But the thrillers, family dramas, like, just amazing books. Girls Like Us, Banker's Wife, Darlings, This Was Not the Plan. They're all fabulous. And I highly recommend you reading it. But I always talk about her because she really is my idol. And, in sort of the literary spectrum, there's 2 sides. There's, and she might not say it the same way I would. So, this is me fumbling this, but there's, incredibly literary authors, which might be very, perfectly trained, authors, but, write about things that might not have a big readership. And then there's, commercial authors, that might, produce more work that's less technically good and, but they sell a lot more copies. And so, I think there's like, and there's obviously books that cross over and all that, but that I think is kind of like, a spectrum that exists. And I've never wanted to be, sort of, I always said that she is, in my mind, because she is my favorite author, she is the most commercial of literary authors and the most literary of commercial authors. And she's the perfect sweet spot on that spectrum. And, that's what I want us to be. I don't want us to be too small where we, don't have a big impact in what we do and we can't leave a mark and in everything we do. And then, I don't want us to be too big to where we actually can't do, where we just do a commoditized job. And so, like everything in life, I try to, follow her and be at that sweet spot of where scale is to our advantage. It can give us impact and allow us to do our jobs better. And so, that's been a very valuable addition to the company, because it's a lot of, we've been able to really innovate a lot more and try a lot more and have a lot more scale and breadth to it, but only if done in a smart and strategic way.
How did you start EOS? Like, what was the process of building the company, capitalizing the company, and then getting capital to make investments?
When I first had the idea of starting EOS, it was probably a couple years before I actually did. And, I wanted to make sure that everything was buttoned up at my previous firm before I left. That was very important to me. I had a couple of investors that said that they were interested in backing me, for a couple years before I ultimately started it. And so, the process was, a lot of thought, making sure everything was sort of buttoned up behind me and, kind of thinking that I had a couple of partners, and investors that would back me going forward. But I didn't want to start anything until I had left. And so, it really, it really started at the end of 2016, early 2017, off of, with a couple of people I had a lot of trust in over the last 20 years that they would be there to support me. And, and it really played on this notion from, the highest level was the hotel business the travel industry has great tailwinds. People want to travel, people want experiences. And, we see that, but that there's so much fragmentation in the industry that if you can actually align interests better and get rid of a lot of the leakage, that you can buy high quality real estate and make better returns than any other form of real estate out there. That was the thesis. And we had a great track record of 10 years of doing it. And we made a lot of mistakes that I wanted to improve on and learn from. And that was really the thesis, and believing that we had optionality and people to capitalize us at the onset. And then, like anything in life, we started, maybe the timing was very late cycle, but we always thought there were things that you would be able to find and do. And we did, although, less before COVID. And then, we've just sort of like made sure that we are trying to anticipate downfalls, along the way. But it was really just conviction that I wanted to do something on my own, that would leave a lasting impact, maybe create something that could outlive me and something I could be proud of.
Looking back at some of those mistakes, maybe in the early days or at your prior firm, what would you tell someone looking to start a hospitality, private equity, real estate firm about building the business from the early stages and also finding and building a team in those early stages as well?
Those are great questions. I think I would say, one of the things that I think is surprising about starting a business And that's why I have great respect for you and everybody else that does it and want to help people that start their own businesses, as is that you have to be patient because it takes a long time. And you have to be prepared for, anything to come at you. And that's exciting. Like there's a lot of excitement in that, but there's also a lot of, you have to be resilient because you truly don't know what's going to come. And in that period of time, you'll also learn a lot about who cares about you, and who your friends are. There'll be people that sometimes you're like, oh, well, gosh, like if I start this, I could imagine these people will be super helpful. And you call them and they're like, oh, that's so great. We're so happy for you. And you're like, okay, like, all right. And then you'll find people that, you didn't expect to be helpful will be incredibly helpful. And it's just, the world's an interesting place like that, right? You don't know what's going on in everybody's life at any point in time. So I think it's that, you really want to feel like you've got good supporters. First and foremost, you need to make sure you've got support at home. Because again, like my wife's been with me every step of the way during this process, got 3 young kids. And if you don't have all that support from at home, you don't have the mental space to sort of like create what you're doing on the work side. On the team front, what I think is, the team front is a constant evolution. And, early on, I think that the most important thing that I found is to hire people that you trust, because, at that early stage, trust is important, talent is important. And so if you can get the most trusted people that you have in your network, that you have worked with before, and that are talented and you know what you're going to get, I think that is just incredibly valuable. I think that pretty quickly what you learn if the business evolves is that you pretty quickly have to be, growing and hiring outside your network. And, at the end of the day, talent attraction and talent acquisition, and then giving people the place where they can do their best work is ultimately, I think going to be the major driver of success, because these businesses are so based on people. They're so based on, I believe culture and retention and everything. And so, you have to start thinking about that early and often, because I do think, especially, as the world becomes more volatile, being surrounded by very talented people allows you to free up to continue to do more and more.
How have you figured out how to incentivize people on the operations side with an investment mindset? Incentives on the investment side are pretty straightforward. I think that's very well talked about. But how do you make the connection on the operations side?
So, maybe this is me being a little simplistic, and, and I know it's not perfect, but we basically incentivize them exactly the same way that we're incentivized on the ownership side. And so, the point is that what we really want is for the operations team to think like owners. And it is really remarkable, because if you think about like what people at the property, and think about, a general manager, right? They're focused on their guests, right? And they're focused on their employees, right? And they're focused on their profitability or value creation. But on a day-to-day basis, you always have, guests that could be happier. You have employees that might be, stressed or working hard. And, I think that the result of that is, you could see like very easily, like, okay, well, just hire more people, offer more amenities, spend more money. Right. And, that makes my life easier, and that's great. But, but does it really? But it's an easy sort of like thing to say you're working towards. And the minute you actually start making, the teams think about ROI, right, is, well, like, and does that extra person really make this hotel make more money? Does that really make overall the guests feel better? How are we allocating the monies that we do have? Like, what are the things that sit outside my P&L? Like, are there neighbors that I could create better relationships with? Are there things like that? And once you start getting the leadership team at properties to start thinking like owners in that way, it really has this unbelievably remarkable effect, because they're really making hundreds of decisions a day that impact the overall trajectory of the investment. And it also allows ownership and everybody to talk to them on the exact same level, where they're like, oh, we get it, right? Like, and it's a balance, because they have very complex problems they're dealing with. They have to make decisions very quickly, and they need the authority to be able to do that. But once you get that mindset there, the amount of involvement that you need, actually from people outside the property that don't know what's going on a day-to-day basis, goes down. They feel more ownership over what they're doing and control. And it's all aligned because we're all sort of in it together. And so is it perfect? No. Is it better than I've seen? Yes.
Someone recommended this book to me called The Great Game of Business, and I started reading it. And the premise is essentially making employees convert to an owner mindset, but also very much like sharing the financials with all levels of employees. And I'm not done with the book, and I'm certainly not there yet, sharing the full financials with all levels of the employees. But we had a monthly business review last week, and I kind of made a very simple slide presentation for the corporate operations team, like what happens beyond the hotel P&L and how much the hotel P&L impacts everything on the ownership side, after debt service, and what the returns are and what distributions are, factoring in CapEx projects, et cetera. And it was in one hotel where the first half of the year, they just crushed it. And then in 2 months, they almost lost all the gains they had made above budget. And I was basically showing them, like, look how quickly it can all fall apart. And you may think it's just falling apart on the top line, but look at the impact it has on the bottom line. And it was basically like, we raise money from individual investors. We expect certain returns, and based around this strategy. And what you are doing in sales has a direct impact on our ability to grow the company, to raise new investors, to have this be a successful investment. And it was pretty interesting, because we've never done that before.
Yeah, I think like open sharing of all that is amazing. And how people fit into the larger ecosystem and what we're trying to do and how that impacts it, I think is really remarkable. And I think we have to figure out how to do more of it. But I agree with the philosophy wholeheartedly, because you can all of a sudden take someone from being like, wait, I don't understand why this isn't happening yet, to, oh, I get the issues that Jake's dealing with. And I also agree that if I had a priority list, that would be number 4, and that we can only deal with 3 right now. And so that makes me feel good. I can understand that. I can explain that to my teams. And I think that transparency and all of that is so important and incredibly powerful.
It is. I'll keep you posted how it's working. I want to bring it home, Jonathan, with like an interesting question. Where do your investments most often go wrong?
We've been pretty fortunate to have investments that have, at EOS, which is only the majority of our investments are actually fairly early in their life. They're going well. I would say 2 things. I'd say in the current environment, the thing that has been tougher is actually getting from sort of planning to execution to finish of renovations. And so, when that lags, we are in a business that's time dependent. And so, making sure that we are, staying on top of, the timing of implementation is important, because it's easy to say, things are going really well, we can just wait a year. But ultimately, if that happens, it can be a drag. And so I'd say, making sure that the appropriate urgency is there to get things done, sort of when we say we're going to, and usually that happens on investments that are going really well, because you're sort of like, wait, no, it's okay. Let's wait a year. And so it's the balance of implementation or, proactively deciding to hold something, I'd say is probably the biggest challenge that we're dealing with right now as we come out of COVID, and like supply chain issues and just overall renovation related stuff. And then I'd say, like, over the course of my career, I think that, the most challenging things are when we ever stray away from like our fundamental beliefs. So if there's something that we fundamentally, say we are not going to invest in markets that have a lot of supply growth, and we say, oh, but this is a little bit different because this hotel's immune or this or that, ultimately I've seen it just come back to just be headwinds that make things harder and take up a lot more time. And I think the hard thing there, or I guess, maybe this is me being a little hard-headed, is we usually don't stray away from our fundamental beliefs. And, we've been wrong plenty of times, and we're usually wrong by missing opportunity rather than getting into something that we regret later. But, once we've missed it, I usually don't feel a desire to sort of jump in late.
I ask the same traditional closing question to all guests on the podcast. And that is, out of all the hotels in the world, in your portfolio, out of your portfolio, it doesn't matter, what's your favorite hotel?
I have a couple, and I'm going to keep it all in the portfolio. Hotel in the Florida Keys called Isla Bella. In many ways, I was part of the start of the company. And so that is sort of very near and dear to my heart. And I usually try to get down there with the family once a year, and we have some great memories down there. So that is, I think that if I had to keep one, I think because I spend family time down there. It was, very early in the life of the creation of EOS. And, I do love the Florida Keys. I would say that is probably the hotel that I would pick number one.
Florida Keys are amazing. Why was it such a good deal?
Why was it such a good deal? It's very hard to build down there. And so, really the main developer in the Florida Keys over the last 40 years has been somebody who I'm very close to. His name's Pritam Singh. He built the hotel. He built a great hotel, built it, he builds really well. He, builds pretty inexpensively. So, assets are worth a lot more than, they ultimately cost. So he was able to make a big profit. We were able to, buy into it sort of upon completion and create a great structure that worked for everybody incredibly well. And then the hotel just continues to do really well.
Thanks for coming on the podcast. This was awesome.
Thanks for having me, Jake.
Hey everyone, it's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter @JWurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.